Is the classic 60-40 portfolio still right for retirees today? In this video, I'm going to go over why the 60-40 portfolio became so famous, why it worked for so well for so long, and why it may be a mistake. Then I'll show you some alternative portfolios and tweaks that you can try yourself that may give you better odds of success in your situation. Let's start with a quick history lesson. The idea behind the 60-40 gained popularity when it was featured in the research of a famous 1950s economist named Harry Markowitz. Markowitz was developing something that he called modern portfolio theory. And I promise you, I'm not going to get into everything on modern portfolio theory. I'm going to try and stick directly to how it relates to the 60-40. But in simple terms, modern portfolio theory was an attempt to mathematically prove what kind of portfolio gives you the best trade-off between risk and return. Instead of just saying what investment earns the highest return, Markowitz asked how much volatility is required to get that return. And what happens if you combine different types of investments that don't always move in the same direction? Their correlations differ. So the results from Markowitz's studies showed that by diversifying across assets like stocks and bonds, you could get a smoother ride for a given level of return, or more return for a given level of risk. And in many ways, this research was totally groundbreaking. This wasn't just about picking a few good stocks anymore, it was about how the whole portfolio behaved. He ended up being awarded the Nobel Prize for his work, and over time, the idea of a balanced portfolio, often simplified to the 60% stocks, 40% bonds, raced to new levels of popularity. So when you hear 60-40, you're usually hearing shorthand for a diversified portfolio that balances growth from stocks with stability and income from bonds. Okay, so that's the theory. But why did the 60-40 do so well for so long? Well, there's a few reasons. Stocks have historically grown a lot over time. Over decades, well-diversified stock portfolios, like broad index funds, have had strong returns. That's the 60 part. Doing its job, growing. Now, bonds, historically, have paid decent interest, and interest rates were trending down for quite a long time. So from the 1980s through the 2010s, interest rates generally fell. When interest rates fall, existing bond prices often go up in price. So bonds weren't just paying interest, they were also getting a tailwind from falling rates. So that helped your 40 portion of the portfolio. So those things working in tandem really worked well together. But stocks and bonds often moved differently. Not perfectly, but enough that when stocks were having a rough year, bonds often held up or even did well. That diversification smoothed out the ride. You often hear that referred to as a flight from stocks to bonds, a flight to safety. So the 60-40 portfolio became this workhorse. It gave you solid growth from stocks, income and stability from bonds, and the combination kept volatility more than manageable than owning 100% stocks. So for a long time, especially for shorter retirements and more traditional interest rate environments, 60-40 was a very reasonable starting point. Now let's talk about how this is supposed to work in retirement, not just in the textbooks. So the idea is stocks are the growth engine of your portfolio. They have higher long-term return potential, but they are volatile. There's a roller coaster ride. Bonds are your stability and income engine, and they tend to move less. The roller coaster ride is a little bit smoother, but they pay interest. In retirement, one common approach looks like this. And this is something that we use a lot too. It is that you use your bonds interest payments as part of your income. You can also sell a portion of your bond funds when you need more income. When the stock market rises, you trim some of the gains from the stocks and use that to put into your bond portion. When the stock market declines, you can avoid selling stocks at their lower prices and instead draw more on from your bonds, which ideally have held up better and may have even appreciated as that flight to safety occurs. You'll have a big enough chunk of bonds set aside to ride out those ugly stock market downturns without panicking and locking in losses. Eventually, stocks will rebound, as they always have. Then at that time, you would repeat the cycle again trimming the stocks if they've appreciated, and refilling those bonds that you are relying on. So that's the logic behind the 60/40 portfolio, and it works really, really well. Growth from stocks, stability and income from bonds, and a rebalancing process that keeps you from making emotional decisions at the worst times. Okay, so the 60/40 sounds great. There's all these great things about it. When could it ever go wrong? Well, the world that people are retiring into now does look very different than the world where the 60/40 became famous. There's quite a few things that have shifted. Number one being that people are living longer. Nowadays, we are seeing longer retirements. Think about someone that retires at 55. Both of their parents lived until, let's say, their mid-90s. Of course, we never know when we're going to pass away, but that person, based on their DNA makeup, could perhaps realistically plan for 40-year retirement. We don't know, but that's what we'll go off. So that's a 40-year retirement period, and for some people, that could be almost as long as their career. So if they stick with a very traditional 60/40 retirement portfolio, there is a real risk that the portfolio doesn't grow fast enough after withdrawals and inflation. They slowly eat into their account, and later in life, they may not have enough left over to keep their current lifestyle going. The 60/40 wasn't meant to go that long. So a longer retirement usually means you need a higher growth component, which often means more stocks over time than a simple 60/40 would suggest. A second thing to consider is inflation risk. We've also gone through a period recently where inflation has woken back up. Inflation can really hurt retirees. Your grocery bill, travel, healthcare, property taxes, they can all rise. And if too much of your money is in bonds with those fixed payments, those payments don't grow with inflation. So over time, that steady bond income buys less and less. Stocks, real estate, and other real assets have at least some ability to keep up with inflation because their cash flows and value can rise over time. Bonds, not so much. So a third thing that's different today than it was decades ago is interest rates. When interest rates move up, bond prices go down, especially for long-term bonds. That can be even more magnified for them. So if you're holding on to a big chunk of your portfolio in bonds and rates rise, the value of those bonds can drop. At the same time, inflation is eroding their purchasing power. This is something that we really saw in 2022. At that time, inflation was running high, and to control it, the Fed raised interest rates. So if you're not careful, you can get hit on both fronts. Your bond values are dropping, and your income doesn't go as far as it used to. Now, all this doesn't mean that bonds are bad. It just means that sticking blindly to a 40% allocation, because some theory that was developed many years ago says so, is probably not the best game plan. Okay, so if not for 60/40, what should you do instead? So here are a few examples. Dividend-paying stocks. These can provide current income through dividends plus growth potential over time. They still behave like stocks, so there's some volatility to them, but they can be a nice bridge between income and growth. Second thing may be real estate exposure. So that might be through REITs or real estate investment trusts or just real estate focused funds. Real estate has its own risks, but over time it can act as a partial inflation hedge since rents and property values also tend to rise in inflationary environments. Something else could be short-term bonds or bond ladders. Instead of loading up on long-term bonds that are very sensitive to interest rates, some retirees use shorter-term bonds or bond ladders to better manage interest rate risk and maturity risk. Cash and cash-like holdings for near-term spending. Some retirees may want to keep 1 to 3 years of planned withdrawals in safer, more liquid assets that can help you ride out market downturns without being forced to sell stocks during bad times. So to be totally clear, I'm not saying throw out the 60/40 portfolio and buy a bunch of other stuff. What I'm saying is the core idea of balancing growth and stability is still very sound. But for many people, 40% of your portfolio in traditional bonds may be too much, especially with longer retirements and higher inflation possibilities. So blending in a little real estate, some dividend-focused funds, and being thoughtful about the types of bonds you can hold can give you a lot of benefits, such as multiple potential income streams, better inflation protection, and still enough stability to be able to sleep at night. So whether the 60-40 portfolio is right for you depends on a lot. You need to look at how long your retirement might last, how much you want to spend in your retirement, especially in the early years, what other income sources you have. Maybe it's just Social Security, but maybe you also have a pension or rental income. Consider how you personally react to market volatility. Do you panic, or do you think, I want to put more money in? And think about what really matters to you. Is it leaving a legacy, maximizing what you can spend over the course of your lifetime? Or is it just about never running out of money? For many people, a 60-40 portfolio implemented well with good funds and disciplined rebalancing is still a very reasonable approach. But for others, especially those with long retirements or very aggressive early retirement spending, sticking to the 60-40 without thinking about it can be a mistake. So if you take one thing away, let it be this. Don't adopt a portfolio just because it's the standard. Make sure it actually matches your retirement reality. So if you'd like for someone to walk through that with you and look at your numbers, your goals, help you figure out what mix makes sense for you, that's what I do for clients. That's my job, and something I'd be happy to do if you'd like to set something up. You can always schedule via the link in my bio or scan this QR code here. But either way, I hope that this helps and gives you something to think about as you're considering what's going to be best for your own situation. Thanks for watching, and good luck to you in your own retirement planning.